Hello and welcome to episode 185 of the Money to the Masses podcast with your resident expert as always, Damien Fay and me, Andy Leakes. Damien, we're a bit down and disappointed, and spoiler alert if you haven't watched it or heard the news, but England are out of the World Cup, mate. Sorry to report that.
This has been quite funny actually, because Andy and I, obviously, before the podcast, have a bit of a mini catch up before we go on pod and start recording, and Andy's just had like a 10-minute rant about the football, and we've been dissecting everything about the England performance in the World Cup. So thankfully we've got that out of our system, so we won't talk about it. We'll just do the money stuff today. But yes, unfortunately, Andy, we our dreams didn't come true. It didn't come home. But there we go. But apart from the football, how you been? You been good?
I've literally got nothing. I've lived the last week in the shadow of the football, and now the football has happened, and we all know what happened. I've got nothing. I'm going to go straight on to you. How was your week? Because if I say what's gone on in my week, it's really depressing. It's literally me eating lots and lots of snacks, getting very, very fat and being very, very depressed. And no one wants to hear about that. So how was your week been?
And there's me laughing. It's been similar, but I have almost achieved a life goal and reflected glory in everything, because technically my daughter is the one who has almost completed a World Cup Panini sticker album, something I never ever was able to achieve in my lifetime. So on the basis that she does that, I'm taking that as a lifetime achievement of my own. And so that I'm being positive. So that's been pretty good. And
it's funny you should bring that up on a money podcast, because I think in terms of money, that's possibly one of my biggest extravagances and expenses in the last 12 years or so, because I did the same thing, not this World Cup, but a couple of World Cups ago, and I tried to get my children into it. And rather than doing the same thing, which is finding other people who are doing things, swapping stickers and maybe sending off and getting copies, I just tried to luck it out. And so I just kept buying more and more and more and more and more packets on the vain hope that I might get the one or two that I needed. And I must have spent over £100 in the last couple of weeks just trying to find one or two stickers, which is just crazy.
Some mathematician professor did some analysis on how much money you'd have to spend to try and complete one, and it was like about £500. But we kind of lucked out, because there was one of my daughter's teammates, her football teammates, is the same age, 8. She had family had clearly spent a fortune on stickers, and she came armed with a shoebox full of swapsies and just gave them to my daughter. And bearing in mind they are, you got 80p a pack, and there were 5 stickers in a pack. I reckon there could be close to 1,000 in this box. You could probably complete a couple of albums. So that was the secret weapon, generosity. So we're going to have to return that, which is quite incredible. But anyway, aside from that, nothing much. I'm trying to avoid my daughter's sports day this week. Not the sports day itself, but the dad's race, obviously, because any long-term listeners will know about my own embarrassments on dad races and hamstrings. So yeah, it's been the good and the bad. But there we go. So
what have we got money-wise this week? What's coming up on this week's show?
Well, on this week's show, Andy, there are 3 pieces. They've got a slight investment bias this week, but they are incredibly interesting. Investor biases. So, as an investor, we all have innate biases. Behavioural finance is the terminology, so the study of how we make decisions. And I want to talk about a few of the main ones that stop us being good investors. So that would interest anyone into investing. I'm also going to look at property returns versus other assets over time, and see if is property a good investment. And the last one is on withdrawing your pension. When you get to the point that you're going to start drawing an income from your pension, particularly via drawdown, so where you leave the money invested and you take a regular income out of it rather than buy an annuity, what is a good rate, or a sustainable rate, I should say, to be able to take money out? There's a lot of debate that people are cashing in their pensions, or they're taking too much too quickly and they'll run out of money because we're all living longer. So I'm going to give you some insight into what is a good figure to aim for. Sorry, can I just say that, Andy, are you making notes?
It's only taken 185 episodes.
I just call Andy. He's jotting down what we're talking about. I'm impressed. You've obviously you've turned over far more. Basically, you're paying attention. Good on you. Before we start the podcast, let's talk reviews. So, leave us a review on iTunes. If you listen to the podcast, the reviews help us push us up the charts, make us ever more popular, and show us how much you like what we do. And it's very motivating. I just want to give a quick shout out to Kevin Kitely, or is it Kitely or Kilty, I think it is actually, who sent some amazing feedback to me this week via Facebook and left an iTunes review. I'm going to read out his review. 5 stars, informative and useful. He says, I've just started to get into a position in life where I can think about more than paying bills and getting by. I found this podcast at the perfect time. It's approachable, informative, giving free, entertaining, that's you Andy, financial advice. The articles cover everything from investments to insurance, scams to coupons. I've binged the back catalogue that's on iTunes in about a month, and I find every episode has something that inspires me. The sister podcast, One Giant Leap, is great, and I can't wait for the next season. So go and have a look at the reviews. Leave one if you can, because it helps us. And I'll read out some of the others that we've got in next week.
Great stuff. So what are we going to start with? Investor biases? Property?
Let's go with investor biases, and we can crack straight on. Now, behavioural finance is interesting. As I said, it's the study of how we make decisions. And more importantly, we always have biases that help shortcut decisions in life, so we don't have to think through them from beginning to end. And what tends to happen, these shortcuts actually mean that we can end up making bad decisions. So there are around about 100 of these that have been identified. Now, I'm not going to go through all 100. I'm going to pick 3 of the key ones that have been shown to be perhaps some of the biggest in terms of making us make bad decisions. Now, 80/20 investor members will be interested and excited to know that I'm going to expand on this fully in a future newsletter to them and talk about a lot of the others and explain what they are and how you can defend against them. So I'm going to go through 3 of them. I'm going to talk about what they are, basically the risks they pose to you as an investor, and how you defend against them. Now, the first one is confirmation bias. Now, this is a biggie. And it's one that we've touched upon probably a few years back on a podcast. And confirmation bias is the tendency for us to look for, whether it's stories or information, that confirm the views that we already hold. Now, to give you an example in the investment world, let's just say you think that China's stock market is about to rebound. We've seen it tank recently, go into bear market territory. Now, you're thinking it's going to rebound. So what you'll do is you'll start Googling or reading or saving down, paying more attention to articles that are talking up the Chinese stock market, that it's actually an opportunity to get in, it's cheap to buy, because it actually confirms what you already think. The danger with that is that you're just going down a very narrow field of confirming your prior view, which could be completely incorrect. And so you could end up therefore putting your mortgage on Chinese equities, and what ends up happening is the market goes even further south and you lose lots of money. That's the risk of confirmation bias, but we see it everywhere. It's not just in investing. You get confirmation biases in political views. People will only go and talk to other nutters just like them when they hold some sort of view. And
Damien, it happened with the football and it's coming home. It's exactly the same thing. Bias. Everyone started to believe it because people were writing it and saying it.
Yeah, and so what you would do is you would read the article. Good example of that, actually, Andy, because I never buy a newspaper. I tend to read the news online. And this week, after one of the games, I went and bought one of the newspapers because it had some big coverage of the previous night's game that we'd won. The one that we correctly predicted we'd win in last week's podcast. And so I sat down there. My daughter's eyes were just almost, what is this paper thing? What is this weird object that my dad has brought into the house? Yeah, because she doesn't see newspapers because, like I say, I read things online. So she knows what they are, kind of, because she doesn't see me read one. And of course, it was one of the broadsheets. They had some really good coverage, and it took over the entire breakfast table as we were sitting there, as my family disappeared underneath the property section, the money section. And
how everything. It used to be.
Yeah, how it used to be. And one of the things, there was a lot of coverage, obviously, about how good England were doing, and everyone talking about how we'll win the World Cup, which was very positive, and it was great to see. But there was an article in there about reliving about how England were actually, in fact, weren't necessarily that great, and looking at their past failures, and in particular the semi-final of 1990. And I was like, what is this? This is not right. Why is this in there? And I skipped it. I couldn't read that. And that is a form of confirmation bias in a way. I'm only paying attention to the things that confirm my prior view that it was coming home. And so if you take that to the investment world, that's quite a dangerous thing to do. Now, the way you combat it is you either, by knowing that confirmation bias exists, that actually in one way shines a light on perhaps your own behaviour. So you're starting to look for reading articles about, is the market going to go up or is it going to go down? And you're looking for those articles to suggest it. The awareness that confirmation bias exists is likely to make you stop in your tracks. But the real antidote to it is to go and seek the alternative view to the one you hold. And I think that's a good life lesson in any event. And I've talked about it before, about you always seek balance. You should always try and seek balance in everything you think. And if you follow 80/20 Investor and get the newsletters, it's a trend that I always do when I write. I tend to write about something, but then I'll also seek the alternative view to give it a balance, because otherwise you are likely to fall foul of confirmation bias. Now, if we move on to the second one in this piece on behavioural finance, overconfidence bias is a dangerous behavioural trait, and by that we mean the overconfidence that people tend to view their own skills or talents in an overconfident fashion. So let me just say to you, Andy, do you think you're better than average at driving?
Yeah, oh, absolutely, yes.
There we go. If you asked, there was an interesting study that they went and asked a whole range of people doing a range of jobs how they viewed their own skill set. And I would be the same as you, Andy. I'm better than average, way better than average at driving. But they worked out that 90% of people said that. Well, that can't actually be true, because someone's got to be worse than average, otherwise there would be no average. And so the tendency for us to be overconfident in our abilities, then in the investment world, that means our ability to pick winners, our ability to be able to pick stocks or funds that go up. We start thinking that we know better than anybody else. That overconfidence therefore leads to complacency, and also us to perhaps go down the route of picking things and investing more money than we should in something, like my example, in China, or betting on England's coming home. So overconfidence is a danger. It's quite a difficult one to be aware of, because you have to be very self-aware, but you've got to try and be objective. So rather than be subjective about these things, you've got to seek evidence for what your position is or what your skills are suggesting. So one of the key things that I like to try and teach people on 80/20 and just generally is benchmarking, is to benchmark your portfolio. And we did a whole podcast, if you go back, look at our back catalogue, on benchmarking, how to benchmark your portfolio. And by that I mean is how do you objectively assess how well you're doing against the sort of average. So if you take a heavy weighting into UK equities, you need to be able to have a benchmark that reflects your overweight, etc., and against sort of actives versus passive and everything. You can do it, just need a little bit of work, but go back and find that podcast, because I'm not going to cover it now, but you need to be able to benchmark your investing skills and returns objectively, and one way you can do it is to use a passive benchmark of some kind and use them in the proportions that you are investing. And now the final risk, or the bias that can cause a problem, is anchoring. Now, anchoring is an interesting one, and anchoring relates to our need to hold on to, in the investment world, it's particularly to a position or a number. So if you think about it, if you were to buy a fund or a share, your anchor point may be the price you bought in at, because that's the point where you will judge, how have I done, and you'll anchor to that. That becomes the be all and end all of everything with which you judge what's going on. But the danger is, the risk is that if you anchor yourself to a price point, particularly where you entered, you need that to judge how well the investment's doing. But it also means that you start to creep into a fourth one of these biases, which is called loss aversion. That people who have the tendency to be more afraid of losses, they will behave to try and stop losses, or they may cause them to take action more than if they make money, or the ability to, or sort of the potential to make money. So what will happen if you anchor to a price? I get so many emails from people who start to say, should I sell now? I bought in at this and it's going down and I'm on a loss. Should I crystallise a loss? And of course, it's a very personal thing. I can't give people advice on that. All I can say is that I do it. When I make changes to my portfolio, I don't tend to reference the point at which I bought in at. I look at it objectively, whether it's a good investment still now. Is it worth holding at this point? And that will stop you anchoring to a point in the past. So the danger is, as I say, of anchoring is the risk is that you just hold on to something forever based on what you bought in at. You just might have bought in at the wrong time. That's just bad luck. But how you stop yourself doing that is you try and lose sight of the price. Don't obsess about it, and you look at whether it's a good investment now based on where you are at this point in time. Would you buy the investment today, ignoring what's going on in the past? Would you buy it now rather than ignore the price that you bought at? And if the answer is yes, then great. If it's no, then you want to question why you're holding it. And of course, if you have a process that is very objective, that you would sell at certain points, or for example 80/20 has a lot of research around it in articles that I talk about how you might pick and choose funds, and of course in the data tables momentum's built into it. So having a process like that makes you very objective, and it means that you go, well, do you know what, I'm going to sell out of this because there are better opportunities elsewhere. And I've done that in the last week on my portfolio, sold out of a fund that I had crystallised a small loss on, but then you go into the next one, you might make that loss back. So you're not going to be reckless, but it's about being objective and realising that anchoring can have a negative impact on your investment performance. So there you go, Andy. They are the 3 behavioural biases. Technically, I squeezed in a 4th that you should look to avoid.
Great. I think that was really interesting. The bit that I particularly personally loved was that last bit, which is about, would you buy in now? Forget what's happened in the past. Is it a good buy-in option now? If it is, then perhaps keep it. If it's not, then cut your losses. Really interesting stuff. Thanks, Damien. What have we got next? So should we do the property piece?
We'll do the property piece. Before we jump onto that, I just wanted to point out to people, if you listened to last week's podcast. Now, I was really pleased with last week's podcast about the stocks and how it came out. The way I talked through, I lost myself in my enthusiasm about teaching people how to use the stocks app on the phone. Do you remember?
Yes.
And this week was, well, beautiful. It was a beautiful week to look at that and see what was going on, to use what I was talking about last week and trying to predict the stories, interpret the markets, because we had such huge swings this week around the US-China trade, potential trade war, I should say. There is a trade war kind of hotting up. They're doing imposing tariffs on each other's goods. But there was such a lot of noise, speculation, stories coming out that what USA might be doing and what Trump might do, that the market was creating some of the biggest swings overnight in different markets, that it was that stock app was just lighting up. And it was just really interesting to see, because given that the timing of the podcast last week, anyone who had followed it this week would have been seeing some big moves and some interesting moves that they could have related to. So that's going to probably keep happening. It's a bit like astronomy. You get like a peak period, they go, have a look now, and you're going to see some interesting lights or whatever. It's a bit like that. I think the summer stock market, you're going to get some big moves anyway. And the summer is always the time where trading volumes drop. And that means there are less people making trades, people go on holiday. And of course, volatility tends to pick up, because if there's less money moving around, then each individual trade has a disproportionate effect on the ultimate level of the stock market. Right, anyway, property, Andy. This is a very quick piece, really. Is your home your top investment? Now, this was something that was run in one of the national newspapers. I think it was This Is Money, I think it was. But what they looked at, they went back and analysed the average annual return of a number of assets since 1995. Now, I don't know why they picked 1995. I just think that's probably the length of time they had data for. But it was a nice table that came out of it, and I just wanted to just list through it for people's benefit, because just to give them some context of how shares and bonds and things do. Now, the annual percentage return, the average. Now, you've got to think, remember, this is average, so when you annualise the returns, there'll be years where the market tanked 10%, went up 20 or whatever. This is the average. So you're not going to get this average every year, but if you hold over the long term, this is kind of the annualised rate when you work it out. Now, at the top spot was global shares. So they had an annualised return of 8.26% a year. Now, over this time, inflation was around 1.96, I think 2%. So above inflation, it was just over 6% on global shares. Now, they haven't broken that down, they've just said global. So they've just really picked a broad index of some kind, probably a fund. Then UK shares came in at 7.7% annualised. Now, what is interesting is that is actually 5% above inflation, and that does match the deemed long-term average that was being widely publicised in the Barclays Equity Gilt Study, which is a study that looks at over 100 years of stock market and bond market returns and looks at what is that average. So it does seem to tie up with that. Interestingly, residential property then came in at 6.3% a year. Then gold at 6.21%. Commercial property, that's things like factories, shops, retail. You can buy funds that invest into commercial property at 6.1%. And then UK government bonds, so we're talking fixed interest here, bonds at 5.1%. So you can see the range of returns. And of course, those differences do stack up over the long term. And what you're seeing there is the order I listed is largely the order from risk at the top, the most risky at the top to the least risky at the bottom. I just want to chuck a few comments in there before we move on to the next piece. Now, obviously the global shares include an element of currency, because if things are held in a foreign currency, there's a currency kicker, and you have to bear that in mind. We've seen that a lot lately, that the currency can boost returns, but currency can also hamper them. So with the pound has been falling, all your overseas holdings have been given a nice kicker because of the currency exchange when you move it back. So an asset in dollars is worth more in pounds if the pound has been falling while you've held that asset. And we've seen that a lot since Brexit. The UK shares, it's interesting, to, like I say, to see that that's produced a 5% return above inflation. But property, I mean, we are picking a very particular period where property prices went through the roof. We excluded the period basically under this time frame where prior to that house prices did dip quite a lot. So we're talking about like late 80s, 90s, early 90s I should say. So we've excluded that. So there's an element of cherry picking that's slightly gone on here. The other thing is with property, it's not a liquid investment. You got to live in it. It's a house first and foremost. If you'd bought another property, fair enough, but you can't just take money out of it. You can have equity release, which is obviously something we've talked about in the past, where you can take money out of your property via financial product. But there are limitations which you have to understand. Gold, I mean, gold is always, as Warren Buffett said, and I think it's probably the best summary I've ever heard about it, you buy it in the hope that someone is more fearful than you in the future, because gold tends to move up when markets are fearful, and it has very limited uses as an element in its own right. There aren't that many uses for it, so there's no real industrial impact of sort of supply and demand, and it's incredibly volatile as an asset anyway, so I don't really see it as a haven that people think it is. It's certainly not an inflation hedge. And commercial property, the same things about that there isn't the liquidity, but if you buy a fund, then of course, if you're buying a fund in your pension or ISA that invests in commercial property, then you can just sell your units and cash out of it. And obviously bonds are the sort of safest, the same sort of thing. Residential property, there aren't really funds or ways of investing in that as such that are very, very liquid. And also, of course, with residential property, people always forget they're leveraging. They borrow money and go, my house went up, but you've borrowed money and invested it in an asset and then claim all the profit as a result of like your initial investment, but you've actually leveraged that. So if you borrowed money, invested in the stock market and made a killer return, and then, do you see what I mean? And it's not quite the right comparison all the time. So it's just interesting to show that residential property has done well. I'd like to just point out that if you go back to about the 50s and 60s and do the same analysis, I did it a few years ago, residential property moves up about 3%, so it's only just above inflation. It's not as good as what they're saying here, but it does show you that residential property has done well. So hooray to everybody who owns a house, is all I can say on that one.
Excellent stuff. So we're going to go on to pensions now. And so what is a sustainable rate from which you can draw down on your pension?
Well done, Andy. Andy had to read that for a piece of paper because we kept getting it wrong. This is one of those times where you can get insight into something. It's the unintended consequence. It was never the purpose that somebody made a product. But if you look at you lift the bonnet up on something, you get a fantastic bit of insight. And I'm going to elaborate as to why. Now, when you get a pension and your pot is there and you're going to go and retire, you have various options. One might be that you buy an annuity. But far more popular now is you'll take a chunk of your money out of your pension and you may leave the rest invested so it can grow, and then you draw an income down and you can then draw that regularly. But of course, there is that point of how long you're going to live, which you just don't know. How much do you want to take from your pension? How much will your investments grow? What is a sustainable rate at which you can take an income? So how much can you take a year from a pension pot with all that thrown in and still have enough when you are incredibly old to be able to live? Now that is a mind-blowing concept to be able to work that out. But something interesting happened this week, and there was a company, I might as well name them, but there was a company called Vitality, and they're the company, if you ever watch telly and you see Jessica Ennis sitting on a bench with a sausage dog, it's that company. They basically have created products. They've mainly been insurance, whereby if you go to the gym, they reward you by making your insurance premiums cheaper. And you can look all about it. I did a review on it in the past. So you can look on Money to the Masses. Well, what they've done is they've taken that concept of rewarding people for living healthy lifestyles. They've entered the investment and pensions world to try and apply this concept to the investment and pensions world. So rewarding you for basically good, healthy living, and also, interestingly, good financial behaviour. There's the sort of element that I'm interested in. And so, just to explain how I've taken something that in their product and drawn insight from, one of the angles on this new product is that they are rewarding people for sensible withdrawal of their pension. So let's imagine that they have this pension product. It is largely relevant. You don't have to go into detail about it, but what they do is, as part of their product, if you start drawing an income from your pot, they will give you a bonus as a percentage of the income you take each year. They'll give you a nice bonus, a bit like a bit of cash back into your pot, if the level which you draw is like sustainable. So if you don't take anything, they give you quite a nice bonus. They'll reward you for like not spending all your money on a Lamborghini. And as you take more from your pension, that bonus starts to fall. So they don't reward you as much. And actually, this kind of stick and carrot angle starts to peter out. And it gets to a point where they don't reward you at all. So basically what they're saying is, oh my God, Andy, you're taking so much from your pension. This is crazy. We're not going to give you any sort of boosty bonus for good behaviour. Now, if you take the rates at which they apply these bonuses, and I did a lot of calculations around it and looking at the numbers, one of the things is they've had to choose the percentage bonus rate they're going to give you. So how much of your annual income they're going to actually then just give you back in a nice bonus into your pot to say, well done. In order to be able to do that, they've had to get actuaries. So if you don't know what an actuary is a guy I once started training to be one, and then realised that it was quite hard work. And
I was just about to say, it's a very generally it's a very boring person that will take up the job of an actuary because of the technical specifics of the job. But then you just said you trained to be one, so I held back.
Yeah, so look, I don't care. I stopped. But an actuary, let's caveat this: they're very rich people. They don't earn less than six figures, but what they do, I've heard somebody say, if you imagine an accountant and imagine an even more boring an accountant, they're incredibly good at mathematics, and what they do, when a company builds a product, whether it's an investment or an insurance product, when they build a product, they have to take into account all the risks in there when they're making it and they're pricing it. So let's imagine it's a pension product of some kind. In order for it to be profitable for the company, they have to take into account mortality rates of all the people in the population. So what are mortality rates? How likely people are to die, the sort of factors that might influence whether they die sooner or later, how much money they're going to make, how investment markets are going to perform if they leave their money in their pension over time. And you'll start realising that these are all the things that you and I need to really be able to understand but have no insight into if we're going to try and build a strategy. And your advisors should understand, and trust me, they don't understand this stuff because it's incredibly complex. These guys run These actuaries run very, very complex mathematical models they build that crunch all these numbers and all these data they get for the official National Statistics Office and the Office of National Statistics, I should say, and pull this together. And then they can come up with a product that's going to be profitable for a company like Vitality. But where this gets interesting is if you look at how they've designed their product, you can therefore gain an insight into all of this money and knowledge that's gone into working out what they think is a sustainable rate of withdrawal. So if you look at the different bonuses they did, which is what I did, I looked at what the bonuses, and then started to look at the rate at which they take them away. So how quickly do they make the bonuses basically become almost penalties. They go, well, these people give a generous bonus, which obviously if you take no money, but they start to slowly, the bonus reduces the more income you get. But there becomes a sweet spot beyond which the rate at which they then start going, well, we're not going to reward these people, accelerates really quickly to the point where they don't give you anything. So this is the sweet spot of this piece. I look at it between 3% and 5% of your pension pot a year as an income to be taken is clearly a point where they deem to be sustainable, and moving between 3 and 5, they don't deem that to be, they don't penalise you. As soon as you go over 5%, the rate at which those bonuses, so therefore their view of this is not good, starts to accelerate. So the rate at which they start to take away those bonuses. So what this tells you is obviously not taking anything they love, but in the real world, the real reality that you've got to take an income, it's not reality that people just don't touch their pensions. Between 3 and 5% is clearly a point where if you look at the numbers, it must be deemed by their actuaries as a decent sustainable rate. So if you've got a 100 grand pension pot, that means taking £3,000 to £5,000 a year. Now, interestingly, at the other end, the point at which you get to 8%, so if you're taking £8,000 plus a year from your pot, they're having kittens about that. And so that is deemed definitely not sustainable. But before you even get to that, the levels above 5 is clearly where they deem it not sustainable. And they must have made those judgments based on mortality across the UK, investment rates historically. So there you go, a fantastic bit of insight you can get by looking at a product in a slightly different way.
Excellent stuff. Thank you, Damien. You've got to get off and try and avoid the dad's race somehow while still being able to watch your daughter run. So we'll let you get off. If you do need to get in touch or want to get in touch with Damien, please do so. It's at Money to the Masses with a number 2. That's Twitter. And of course, you can email Damien directly at damien@moneytothemasses.com. Damien, we're done. It's been enjoyable. Go avoid the race.
Yeah, let's hope I can walk this time next week. Until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Play. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.